Okay, so what if I told you there's a financial strategy out there that could literally cut your 30-year mortgage down to less than 12 years? Seriously, a strategy that could save you hundreds of thousands of dollars in interest, and you don't have to refinance or completely upend your life to do it. It's a method that puts you, not the bank, in the driver's seat. Let's get into it.
So here's how we're going to break it all down. First, we'll pull back the curtain on the traditional mortgage and its hidden costs. Then we'll introduce a much smarter, principal-first strategy. We'll show you how to unlock the hidden power of your own cash flow, walk through something called the HELOC injection cycle step by step, and finally, we'll reveal the final numbers, which are, trust me, absolutely stunning.
All right, let's just get right to the heart of the matter. The standard 30-year mortgage? It's really designed to benefit one party. And spoiler alert, it isn't you. The whole system is front-loaded with interest, which makes it incredibly, almost ridiculously, hard to build any real equity in those first several years.
Now this right here, this is what you really need to see. This is the harsh reality of it. Let's take a sample mortgage of, say, $775,000. So after 4 years, that's 48 payments, mind you, you've paid the bank over $150,000. But guess how much of your actual loan you've paid off? Only about $49,000. Let that sink in. For every single dollar that went towards you actually owning your home, you handed over $3 straight to the bank. The system is literally designed to keep you in debt for as long as possible.
Just look at that number for a second. Over $150,000. Poof, gone. That's more than a lot of people make in 2 or 3 years, and it's just the price of admission for your mortgage. It's money that just vanishes into the interest abyss, and it barely moves the needle on what you actually owe. This is the financial trap we are here to talk about solving.
So how in the world do we fight back? How do we reverse this equation? Well, we need a totally different approach. We need one that shifts the focus away from just paying the bank's interest and instead goes on the attack, aggressively hitting the principal balance right from the get-go. And here's what it's called, a hybrid amortization model. Now, this isn't a new loan, and it's definitely not a refinance. It's a strategy. It's all about using the financial resources you already have, your own cash flow, but in a much more efficient way to pay down your home faster so you can build real wealth sooner. And this map just illustrates the difference perfectly. You see, traditional banks, and even refinancing, they often operate down here in this low-clarity, low-savings zone. But this principal-first strategy, this eliminate strategy, it sits up here in a quadrant all by itself. High clarity, high control, and maximum savings. This is the kind of powerful information that every homeowner deserves to have. And it really makes you wonder, why aren't more real estate agents, the very people guiding you through the biggest purchase of your life, talking about this?
Now, the engine that drives this entire strategy is something you already have. It's your monthly cash flow. The problem is, right now, it's probably not working nearly as hard for you as it could be. So let's see how we change that.
Just look at this typical scenario. So a household might have, let's say, about $2,200 left over each month after all the bills are paid. Now, if you just park that in a regular old savings account, you might earn, what, $8.54 in interest? I mean, inflation probably ate that and then some before it even showed up. Your money is essentially just taking a nap. But watch this. Watch what happens when we wake that money up and give it a job. If you take that exact same cash flow and you point it at a high-interest debt, like a credit card sitting at 12%, you don't earn a few bucks. You save over $145 in interest you were about to just throw away. That's a massive return on your money.
This is the key right here. You have to get this in your head. Money saved is money earned. Saving that $145 in interest is a guaranteed risk-free return. It's way more powerful than any tiny gain you're going to get from a savings account. And this is the exact principle we are about to put on steroids.
Okay, now for the masterclass. How do we actually pull this off? Well, we use a very powerful financial tool called a home equity line of credit, or a HELOC. But here's the trick. We're not using it as more debt. We're using it as a high-speed vehicle to pay off our mortgage.
And the process is actually a really simple, repeatable 5-step loop. First, you access your home's equity with a HELOC. Step 2, you use some of that to completely wipe out any high-interest debt like credit cards. Step 3, you take the rest and inject it like a torpedo directly into your mortgage principal. Then, and this is key, you use all that cash flow you just freed up to aggressively pay down the HELOC. And once that's done, you just repeat the cycle.
And you feel the effect of this on day one. I mean, look at these numbers. By using just a part of that HELOC to get rid of an $800 credit card payment, for instance, your monthly cash flow instantly jumps. In this example, it goes from about $2,200 to almost $3,000 a month. Now, that's not new income you had to go out and earn. That's money you were already spending, but now you've repurposed it to work for you. And that extra cash flow becomes the rocket fuel for paying down that HELOC at lightning speed.
So, we've laid out the problem, we've walked through the strategy. Now, let's get to the results. This is where it all comes together. And believe me, these numbers are truly life-changing. Here it is, the side-by-side comparison. With a traditional 30-year mortgage, you're on the hook for over $722,000 in interest. Yikes. Now, making extra payments on your own is good, don't get me wrong. It saves you a ton. But look at the line of credit strategy. You pay off the mortgage even faster, and you save an additional $50,000 on top of that. It's simply the most efficient path to being debt-free.
Let's just pause on that for a second. Your 30-year financial sentence is slashed to just under 12 years. What does that actually mean for your life? It means more than 18 years. 18 years where you have no mortgage payment. 18 years where all that money is yours to save, to invest, to travel, to do whatever you want with. That is real financial freedom you just took back from the bank.
And here is the big one, the bottom line. Even after you account for every penny of interest you paid on the HELOC along the way, the net savings is a staggering $443,000. That is nearly $500,000 that stays in your pocket. That is generational wealth for your family, not for the bank's bottom line. It's the direct result of making your money work smarter, not harder. So we have to end with this question. Really think about it. What would you do with that extra time and that extra money? Would you retire early, travel the world, pay for your kids' college education, no problem? This isn't some lottery fantasy. It is the mathematical result of a smarter financial strategy, a strategy you now know. So the real question is, why isn't your realtor, your mortgage broker, your financial advisor telling you this? Maybe it's time you told them.